Good morning, ladies and gentlemen, and welcome to our annual conference, Getting Back to Business, Planning for Greener Pastures in 2022 and beyond. As we planned for this conference, we were versed in the lifting of restrictions of COVID-19, which turned everyone's world upside down for the last 2 years. However, we were oblivious to the Russian war in Ukraine and the bloodshed, turmoil and utter disbelief this has caused in the last 3 weeks. Our thoughts are with the Ukrainian people at this sad time, and we hope an end will be in sight without much more bloodshed and loss of life. The COVID pandemic has brought about much change in our habits, our attitude, change in our workplace, and change in how people go about their work. Climate change is still high on everyone's agenda. Our speakers today will provide you with vital insights into these topics, with John Finn discussing the economic situation, Clodagh will discuss hybrid working and the pros and cons around same. EI have been to the forefront in supporting Irish business growth throughout the pandemic, and Russell-Walsh will give an insight into what future funding is available as EI continues to support the growth Irish SME in Ireland and in exporting to the UK and Europe. With oil prices soaring, the climate change topic still high on the agenda, John Mullins will give an insight into alternative energy and what the future holds. I will discuss the topic of succession, planning for exiting business in a productive and a tax-efficient manner. We have a packed and topical agenda today for you, and before we start, I would like to thank a few people without whom this would not be possible. I would like to thank all my staff for their hard work, dedication and professionalism throughout this pandemic and for providing a top-class service to all our clients. I would like to thank our clients who allow us to provide our services to them and for their loyalty over many years. I would like to thank our speakers, John Finn, Clodagh Russell-Walsh and John Mullins for giving up their time this morning. Finally, I would like to thank Jackie Walsh, our office manager, ably assisted by Cy Warren, for coordinating marketing and putting together this conference. I hope you enjoy our morning. Now, our first speaker this morning is John Finn, and John is going to discuss Treasury, banking, economic, markets, etc. John, good morning.
Good morning, Paul. Thank you for that. We'll just make sure that this loads up first. And so can you see that, Paul? You can?
Yes, I can. And thanks, John. This is, I would think, possibly conference number 7 or 8 that you have shared with us, and we're delighted to have you here again this morning.
Not at all. Thank you, Paul. And good morning, everybody. I have quite a number of slides to go through. As you can imagine, there's an awful lot happening in this space. So we're going to move straight away and put my timer on here. Okay. So we're going to cover foreign exchange, interest rates, banking and other data, and then we'll wrap it up at the end. And I think if you want to ask questions, you might put them into the question box and Paul will collate them and I'll try and answer them at the end of the session. So foreign exchange very quickly. We're going to look at recent trends, the current outlook, and maybe talk very briefly about currency policy and strategy development. So looking back briefly, and in some respects, all of this has been rendered largely irrelevant by what's happened in the Ukraine over the last couple of weeks. But Brexit was one of the key things that drove foreign exchanges over the last couple of years. Interest rates and inflation have come to the fore really only over the second half of last year, but they are very important. Politics, we can see what's happening in politics. I don't need to say it. And clearly the pandemic had shaped a lot of that. But coming into 22, with a number of emerging themes there, and particularly the inflation side. This is Euro Sterling 10-year trend. I think, as Paul has alluded, the first session I spoke at was around 2015, 2016, prior to the Brexit vote, when we told people the currency was in the low 70s, I should say. And I think we predicted it was going to go to above 80 very quickly, and it did. And you can see in that channel there, it's pretty much hung around 80 to 95p ever since. And if we look at this one, which is probably better over the last 2 years, you can see that since, and particularly last year, since the Brexit, at least we knew what happened when Brexit finally, they weren't crashing out. You can see that sterling's been in a strengthening channel. That channel there is about 85.80 down to about 82.20, and it's holding quite well. So we're watching that for the last while. It seems to bounce off the bottom and come back up again. And but the good news, I suppose, for exporters is that we're seeing the exchange rate averaging around 3 or 4p better than it was compared to the previous few years, which has been a welcome relief to exporters. And indeed, they may need it with costs going up elsewhere. But as you can see, it's settled down in this kind of mid-80s range for the last while. And just put this slide up very quickly. I think we can give you the stuff afterwards. But traditionally, what you can see is that you have the averages up to certainly this year over the Brexit period were relatively tight, 87, 88p, not moving hugely. We're averaging, say, 83.66 so far this year. But annual volatility, in other words, the highs and lows, the gap between the high and the low of any one year is around 10% with the occasional outlier. So what I'm trying to say there is that if you don't have a hedging policy in place and you're buying when you think it's good or selling when you think it's good, there is an element of risk about that if you don't have a structure to it. So you get it right, you could get it very right. You get it wrong, you could get it very wrong. Now, I had put these up as the outlook. So this is looking at some of the different banks. And I think really the third point is a crucial one here. Forecasting is impossible in the current environment because the political outlook is really driving everything. And I guess in the short term, you'd have to say that because we have what's happening in Ukraine, it is in Europe, there are likely economic ramifications for Europe. Euro probably, on balance, you'd expect won't strengthen over the course of this year because of those factors. Now, whether the UK can, I guess, can thrive better. One of the key things in the UK would have been Boris Johnson's particular situation and whether he could dodge the bullet and stay on. It looks like he's got lucky again because the Ukrainian events have actually taken the heat off him for now. And that would have been one of the things I would have said might have driven it in sterling. So we'll watch that for later on in the year. Economic outlook obviously doesn't look great now across the board. Inflation equally doesn't look great. Prices are going up, and we'll look at that in a second. And interest rates I'm going to look at in a second again. So really hard to say anything in this stage in terms of where we might see some direction. So I guess what we're saying to people is put a bit of structure in it and keep a balanced look and try not to gamble too much on it. Okay. If I look at move on to euro dollar quickly, it's at 110.50 this morning. And again, that's the 10-year rate. You can see dollar really haven't been weak for a while. This 10 years ago, got into a reasonably tighter range, and exporters to the States have been doing relatively okay. If you look at this for the last 2 years, we can see that it was a period of weakening in 2020 and a period of strengthening in 2021, and it's held up. It's strengthening into the start of 22, mainly because it's a safe haven play. When you get economic or political troubles globally, you tend to see money flowing into dollars, flowing into Swiss francs, and maybe flowing into yen, but certainly Swiss francs and dollars. And that's what we've seen. The dollar actually hit 108 last week after the initial reaction of the markets to the Ukrainian conflict. So again, if you're an exporter to the States, you're looking for opportunities like that to sell. If you're an importer, and we are exposed to the dollar on a number of fronts, those of us who are not buying or selling into the States, we're still exposed to dollar prices on fuel, on energy in general, and indeed on anything that has a petrochemical input, so plastics and things like that. So you need to think about it laterally in that context too. And in the past, quite often what you found is if the price of oil went up, the dollar weakened. Was this a kind of a counterbalance to a certain extent. That hasn't prevailed this year. We've seen the price of oil shooting up and the dollar also strengthening. So it's a double whammy on the price in euros of fuel, as we've seen at the petrol pumps, okay? And again, if I just show these highs, lows, and averages, traditionally, their averages have been a little bit wider than, say, euro sterling, and volatility was also a little bit wider than euro sterling, but it has been narrowing over the last couple of years. But again, the same point is that, you're still getting on average 12, 13, 14% high-low volatility. That's too big a swing to be caught on the wrong side of. So again, the point being that you need to have some sort of strategy in place. There was a wider view of dollar outlooks prior to the Ukraine as regards where it was going to. Some of the international banks were certainly calling dollar weakness, actually. And as I said to you, it's actually benefiting at the minute because of the safe haven status and the geopolitical outlook. I think, I can't see the dollar for the moment heading back towards the 120s. You just couldn't see it right now. So you would have thought it'll hold around the kind of 110, 115 range in the short term, partly because of the safe haven play on the dollar, and partly because, as I said, euro would still be under pressure as well. was also a bit of an interest rate play on the dollar, as in interest rates were rising in the States faster than anywhere else, and therefore money was going into the dollar initially because you're going to get higher returns more quickly on US dollar assets. That has abated a little bit, and again, we look at it in a couple of slides. Inflation is very high, as we know, in the States, extremely high, highest it's been since 1980. And of course, that was one of the reasons why they were driving expectations of interest rate hikes in the States. And we've also got US midterm elections this year, which gives an idea as to whether the Democrats are doing okay or not. And again, as you know, in the States, they have two houses. And if the president, be it Republican or Democrat, can't hold the houses, they get very little done. So the outcome of that would be important in shaping the outlook to the presidential election in 2024. So very quickly, what I'm just saying on policies and strategies is that I would say to you, if you have any sort of material level of currency to buy or sell, you need a currency policy. It's a board-approved document, not a big document, but the idea being that you just, it puts some structure into how you manage your currency. Now, I've been saying this for years, anybody who's been listening to these sessions, and I still, as I've said there at the bottom, only 10 to 15% of companies with currency exposures have a policy, even though 100% of companies with currency exposures have the risk. It's a really undermanaged area of finance. And the point about it is, it's not about guessing whether the dollar is going up or down, sterling is going up or down. It's about trying to make sure you secure your margins and that you're not hammered by surprise moves against you. It's really about that. It's about making sure you don't lose money on currency rather than trying to make money on currency. So, you know, the sequence of events in developing a strategy is identify exposures, quantify them, develop your strategy, implement it, and evaluate it, and keep doing it. You can do it on a monthly basis once you get up and running. And maybe the last point on that I would just like to say is that, you know, identifying exposures, be careful, because sometimes what happens is you might be buying stuff from the UK, they're invoicing you in euros, so you say you have no currency exposure. But of course, all they're doing is they have the currency exposure. And when it comes from year to year and resetting prices, they'll simply look at what the euro sterling rate has done in the previous 12 months. Generally, what happens is that the UK company will find if the currency is moved against them, they'll up their price. If it's moved in their favor, they're unlikely to decrease it. So you actually, in theory, you have a hedge position. In actual fact, what you probably have is a ratchet position. In other words, the price is likely to ratchet up. You're not going to get the moves downwards. So be careful on that one. Okay, moving swiftly along, interest rates. This is 3-month Euribor, a 5-year trend. This has been negative now for quite some time. In fact, this is a 5-year graph, and you can see it's been negative for the whole period of that 5 years. It's dropped to, or increased, I guess, increased in a negative sense. It's just below minus 0.5% this morning, which is the first time it's been at that level in a while. And you'll see a kind of similar trend happening in some of the other ones. Now, it's still a long way off being back to zero. And I guess what we would be saying is that there was a view, certainly in the last couple of weeks pre-Ukraine, that we might have one ECB hike by the end of this year. And if we get that sort of hiking, Euribor rate should follow back up towards or close to zero. That would probably be good news for depositors. We might get away from negative deposit rates, or at least be back to small negative deposit rates. Obviously, the flip side for borrowers is it will begin to drive the variable rate cost of funding up. If we look at the 3-year swaps, you can see that what happened is that this was rising quite quickly. And this is the one to watch, by the way. 3- and 5-year rates are the ones to watch. Don't watch the ECB rates. ECB only look out 3 months at a time for the ECB base rate. By definition, it's a short-term rate. If you want to know where rates are going, you got to look at long-term rates, because they look out 3, 4, 5 years and are a better indicator. Okay. So as you can see from this is below 0% for 3 to 4 years, but has gone up against it. Now, it rose quite quickly there for a couple of weeks, dropped last week, as you can see from this slide. It's back up to 0.32% this morning. Okay, now I did these slides only last Friday when I sent them into Paul. So that's the level of the pace of moves. Okay, so the rates they decreased initially very quickly because of the conflict, because the view was obviously economic slowdown, but actually it's kind of risk back on again, and they've gone up again. And it's the same here on the sterling swap rate. And in fact, the UK rates have been jumping around, and you can see that this, I said the rate had increased by 1.5% prior to the Ukrainian invasion. It had dropped to about 185 towards the end of last week. It's 219 this morning. That's a big move. That's a really big move in a short period of time. And 2010 was the last time that the sterling rate was this high. So if you are in the UK or your sterling borrowings, this has moved an awful lot in a short period of time. And the reason why I put this slide up is because this is what will happen eventually in the Eurozone. you'll get these moves and it'll be very quickly. And, you know, we certainly are gone past the bottom in terms of Eurozone interest rate trend. So just be careful, okay, because this is a sign of what's likely to come at some point in time. On the interest rate outlook, as I've said, the base rate, the view was you might get one hike this year in the ECB. In fact, I can say the same thing for all of these now. Politics and inflation will drive all this. And we're going to get a pincer movement here, and that's the problem. We can see inflationary pressures coming through everywhere prior to what happened in Ukraine. That's only feeding into the oil market, into commodity prices and all that sort of stuff, which will drive inflation higher. The problem with that also is that we're likely to see economic growth stall. So the phrase of stagflation, in other words, stagnant growth, but inflation rising, it really does look like that's going to come through. You're going to hear an awful lot about that more and more over the next 6 months. And because it's a bind for the central banks, if they start hiking interest rates to keep a lid on inflation, the problem is they actually also keep a lid on economic growth. And if economic growth outlooks are not great, you've now got two competing dynamics. We all know that central banks have pumped billions and trillions into economies for years. They wanted to start reining that back in. And of course, how that would be reined in and the pace was what was occupying people prior to what happened in Ukraine a couple of weeks ago. So again, this is going to be the problem. What goes first? Do they hike rates to curb inflation, or do we see inflation as transitory? Now, I would have had a view for a long time. Last year, I didn't believe in this transitory argument. I still don't believe in it. I think we will get a transitory element now at the minute because of what's happened with oil prices and that. But the transitory might be up to 8, 9, 10%. Somebody was talking about yesterday of inflation in the short term. But I think we are into an inflationary period one way or the other for a lot of reasons. And it's going to be a challenge. Okay, I need to keep moving, folks, because I'm just watching the time. Just to flag this very briefly, if any of you are borrowing in the UK moved away from 3-month LIBOR at the end of the year. They're now using overnight SONIA. And the thing you need to take away from this is that, very briefly, on inflation, it's using LIBOR. If we set a rate today, if we wanted to borrow for 3 months, we would agree the rate today, and that would be what we would pay in 3 months' time. But we would know today what we're going to pay in 3 months' time. With SONIA, it works the other way around. You actually take a rate, and at the end of the 3 months, you add up all the overnight rates, basically, and that gives you your 3-month rate. Okay, so you don't actually know at the start of the 3-month period what it's going to cost you. Eurozone is likely to veer towards this in due course. So it's already reality in the UK. It will have systems implications for you for starters, but also all sorts of implications. All I'm saying is I'm bringing it to your attention for now, but please be aware of it. Okay. Right, moving on to banking and other data. I'm just going to put this up first, because I said this is a variety of stuff, but we touch on a lot of stuff very quickly. Irish government gilts, this is the price of the government borrowing. As you can see, they could borrow for negative rates for a while in 2020. Again, like all those other longer term rates, you can see it's increased in the last while. It was at 53 basis points when I said this last Friday. It's at 82.60 this morning. So the cost of government debt is going up again. All the markets seem to be reacting literally in the last 2 or 3 days. And what does that mean? Well, it means that the more that we borrow, and we're still borrowing, the more it's going to cost us. However, this slide here shows you, this is the debt profile of our government debt. So we all know the government's borrowed an awful lot of money to come out of the crisis, the financial crisis, and borrowed a big chunk of money again because of the pandemic. Now, the thing about government borrowing is they issue bonds. Bonds, basically, you pay back the interest every quarter, but you only pay the principal back at the end of the bond. So you pay 100% of the principal at the end. It's not like a mortgage or a loan where it's amortizing. So therefore, this repayment profile of the debt becomes important because this tells you when all these different bonds mature. And what you don't want is a big chunk of bonds maturing at one point in time, because if the markets are ropey or interest rates are high at that point in time, you're very exposed to that repricing and that. What you can see here is the NTMA have done a very good job, to be fair to them, over the last number of years in Ireland, and they've reprofiled our debt a lot. And they've also got a lot of it put away at reasonably low rates. And in fact, if you look at this graph or table here, you can see what it shows basically is, and it's from I think it's from the Department of Finance, shows the percentage of our GDP that our interest bill is. And you can see, okay, our interest bill is actually, it increased, as you can imagine, as a result of the financial crisis. It's actually began to abate again because of 2 reasons. One is interest rates came down, and secondly, when the government was borrowing because of the financial crisis, we could only borrow for short periods of time, 3, 4, 5 years max, because we were in an IMF program. As we came out of that, you can borrow for longer periods again. So the cost of the debt has been good. And the reprofiling of it has also gone very well. Now, moving on to inflation. You can see here, CPI is the retail consumer price index. And I added in producer prices, sometimes because that's a good indicator of what might be coming down the track. It's what input costs for producers. The key thing about this is, the Irish rate is what we're seeing now, 5%, last seen in 2008. CPI has sub-segments, so it's transportation, housing, clothing, food, all that sort of stuff. And I think in some respects it's a crude measure, because I said, depending on what socioeconomic group and demographic you are, you will make an impact. So, like, does higher rent costs impact me? Not directly per se, but I have kids in college, so it does. Going out, obviously, I don't go out much at my age, so going out, because that going up isn't per se an issue, but maybe health costs are an issue for me. So therefore, because of my age. So you really want to understand the sub parts of that and how it impacts on your customers or your employees or whatever. But you can see these levels haven't been seen in yonks. We just had flat and zero inflation rates for a long time. So I put up this as it's a prompt for you more than anything else. Again, I don't want to go through it in much detail, but I want you to take away and have a look at it. And what I'm trying to get people to think about here is, how does inflation and interest rates impact on you or your business? So inflation will impact on economic growth, bond prices, interest rates, equity values, exchange rate, wages, and an impact on all of those. And the same interest rates themselves then, because obviously interest rates have been used as a tool to try and manage inflation. Can impact on mortgages, cost of borrowing for the company, pension valuations, hurdle rates for investment and that. So that's just a takeaway. Sort of think about, just don't think of interest as the cost of borrowing for your company. There's a knock-on effect of inflation on interest rates, and interest rates can have a knock-on effect on a number of different factors. Very quickly, just throwing this in, Brent crude, this is 107. When I said this last Friday, it was 127, I think, on Monday. It's back to 115 this morning. The other one I thought I'd put in, and I'm sure John will talk about this later on, but the cost of carbon credits. I'm sitting on a board of a global Treasury subsidiary, and we buy the carbon credits for the group. And we've been hedging carbon for the last couple of years already. But carbon credits shot up over the last, last quarter of last year into this year. And again, you can see fell off massively there in the last week or two as investors pulled back. So investors were actually driving a good chunk of this market rather than industrial companies that needed to borrow. But again, this shows you the impact of investors, and if I say non-industrial corporates in various markets, because they're massive moves. I mean, if you were hedging buying carbon at 90 euros there last week, and then you see it fall back to 66, you really will be kicking yourself. And gold, last point, gold isn't usually looked at as people as a hedge against, I suppose, if things are slowing down economically, gold tends to go up. So some people use it to keep some element of exposure to gold in their portfolio. Now, banking trends. Excuse me. Very quickly, what am I seeing? Lack of competition goes without saying. It's a challenge. I would be worried about the second point in particular, lack of resourcing. This comes down to a very simple fact. The two main banks have had voluntary redundancy schemes. They have, a lot of people have opted for them. The problem with that is they're right sizing, as they might use that phrase, their business for the next 5 years' time. So they're getting rid of people. But the problem is they get rid of people straight away. Your balance sheet decreases over time. So what you're finding, certainly I'm finding, is that a lot of the lending people in the banks are really under pressure because they're losing headcount straight away, but they're not losing, their loan book is not decreasing fast enough. And that's becoming a real challenge. And I think it's going to be a major factor in the coming 24 months for us. Cash flow versus security, the banks want both. Cash flow is king and will be king, but they still want security if they can. They're very fussy about the quality of information. So in other words, the quality, and think about this, folks, the quality of the provision of information provided to them will have a large bearing on the quality of the output you get from them. It really is good quality in, it'll be good quality out. ESG, you know what the story is there. It's, again, I suppose John will give us certainly a good insight on the environmental side, but ESG is on the agenda. What it means, not quite sure yet. Banks are trying to figure out what you should be doing in the ESG space. So, but it is on the agenda and it's going to develop, so you've got to keep an eye on it. Certainly, as we know, a huge amount of private equity availability in the markets, but there's relatively low levels of leverage. And let me just show you these very quickly. These are lending trends. NFCs is non-financial corporates, in other words, just companies in Ireland. And this is showing 2003 as a base of 100. You can see it peaked in 2008, and we are now back below 2003 levels at the minute. And that shows you since 2010 how it's gone. So the point I'm making here is that SME lending, or lending to non-financial corporates in general in Ireland, was 145 billion in 2008. It's under 35 billion today. So the level of leverage out there is relatively low. This here comes from central bank, and again, you can look at it at some point in time. I won't dwell on it, but it's basically, they show the different average cost of lending from the banks for different subsectors of the economy. So depending on which subsector you fall into, it can have a big effect on the interest margins you are charged. So the ones on the left are the all lending, the ones on the right are on new lending in the last while. So again, that's available, it's publicly available information. In summary, and I'm going to wrap it up very quickly, FX volatility is likely to persist, driven by interest rate and inflation expectations. We've seen some upside for UK exporters, and as I say, don't waste it. A base rate, I think on average, I think the euro base rate is going to remain static in 2022 for now. But you can see the Ukrainian invasion has impacted on rising long-term rates and is now actually driving them back up again. So what are we saying to companies in general in the banking side is, I think it would be a really good idea to start looking at refinancing if your facilities mature in the next 2 years. It's going to take longer because of the resourcing. Uncertainty doesn't help matters. I wouldn't leave it until close to the time I need it. I would start trying to negotiate stuff as soon as you can. I always believe in investing in time with your relationships with your lenders, because it's a relationship game in the business banking 1 to 10 million category. Like I do a mix of stuff from $1 million up to a couple of 100 million. Like the guys in the couple of 100 million have leverage. They're big enough. They can negotiate. It's a different negotiation prospect. It's actually easier, ironically, for the larger amounts. Smaller amounts, you have to invest your time in it. I do think an economic slowdown is likely in Europe. And I said, who's going to pay for sustainability? And the reason why I put that out there is that I think we're going to have to look at a completely new way of how we do business across the board. Across the board, I think we're coming to a new paradigm for business. Sustainability in some respects is a bit like risk management. People don't want to pay for risk management now because it costs them. But if you have to recover from the risk actually coming through, it'll cost you way more. But because that's out there in the future, where you have a cost now, it's easier to avoid the cost now. I think the sustainability is probably in the same category. We're actually probably at a stage where we can't afford not to invest, but people don't necessarily want to invest. I think how we go about this is going to change. Supply chains are going to change, and they are changing. I think even down to, I did a radio interview in the Midlands last week and suggested that we should be looking at energy and food security here as some sort of a backdrop, and just in case, because of the volatile world we're in. As I said, I just think we're going to have to think differently. I am worried about stagflation. There will be a focus on productivity again. There'll have to be a focus on productivity. And we're just going to have to be adaptable and agile as businesses. And I know people are probably sick to hear that, but we are. I really think over the next decade, it's going to be a huge change in how we do so much aspects of business. I'm sure you're going to hear more about it from other speakers during the day. And that's it. I'm going to take questions now. There you go, Paul. I think 25 minutes on the minute.
Thanks, John. I suppose the question coming out would be just the impact of the Russian war in Korea and the longevity that this might go on for, and what do you see the long-term impact of this?
The fact that he hasn't been able to blitzkrieg like he thought he would means it's going to drag out. And I would fear that it'll drag out for a while, and it's not going to be good. And that's, I mean, at a human level, and it does sound very trite in some respects. We talk about economics in the context of what we're seeing at a human level. So I caveat what I'm saying in that context. With all these things, if the challenge is going to come to Putin, it nearly always comes from within. He won't be toppled from outside. So the question really is, do you get so much pressure on the Russian people and the oligarchs and that it becomes a liability? And I think that at the rate it's going, I think I'm surprised at the speed and the scale of the reaction globally of the sanctions. There's really been a unified approach. It will put Russia back decades if they're not careful. Interesting player in all this will also be China. China has sat on the side for a while. It wouldn't be surprising to see China maybe aiding, if I use that word, Russia a little bit more, but of course that means Russia becomes more dependent on China. And I think what you're seeing in some respects here is Russia could be pulling back as a superpower, and China and the States are going to be left. But the worry would be, Paul, that it's, you know, it has to have an economic impact, at least in the short term. And the real key thing is what happens to Putin. Does he get away with it for much longer? Will he be toppled from within? You know, but that's where the pressure is going to come. If you look back historically, it's always from within that the problem comes for the likes of these guys in the end, not from without.
Okay, John, thank you very much for a very detailed presentation. Really appreciate your time.
Too fast, Paul, but we tried to cover as much as we could in the short period.
Absolutely. Thanks, John.
Thank you for the invitation to speak to everybody again this morning. I appreciate that.
Okay, thank you. Okay, next speaker is Clodagh O'Donovan. Clodagh has 20 years experience in HR and founded AdvanceHR to help owners of small businesses successfully manage HR compliance, risk and their people. Clodagh knows how quickly issues can escalate and the cost of businesses in terms of time and money when they do not have an expert they can trust to guide them through the HR best practice and protect their business. Clodagh partners with our clients to understand their business, people and customers and provide them with simple solutions and frameworks that make it easier to manage their HR compliance and people. Clodagh loves brainstorming with her clients to find the right solutions that allow them more time to focus on growing their business, developing their people and serving their customers. So I'd like to present Clodagh's presentation now and look forward to hearing. You might be on mute, Clodagh, I think, are you?
Apologies for that, I was. I'm just getting a message saying that I can't start my video because the host has stopped it. Just wondering if there's anything that you need to do on your side.
Just 1 minute now, Clodagh, I'll fix that for you.
Thanks, Jackie. I did manage to get it working just before it all started. So just while Jackie is working her magic there, hopefully you can see the very first slide. Yeah, right. Now, hopefully you can see me now as well. Can everybody see my screen, yes? Yeah, great. Well, I'm assuming that's a yes anyway. So as Paul very kindly introduced me there, my name is Clodagh O'Donovan. I'm the owner of AdvanceHR. And I support SMEs with everything HR related. I'm very honoured to be here today just to talk to you about the elements of the right to request remote working bill, and just to discuss the pros and cons of it, look at the different grounds that an employer can decline the remote request, and touch on another new piece of legislation coming down the track with regards to statutory sick pay. And I'll be delighted to take any questions at the end. So to kick off, I'm just going to have a look at the overview of the National Remote Work Strategy, then look at the right to request remote working bill, look at the pros and cons as I mentioned, and the grounds for businesses to decline the requests. So in a nutshell, the National Remote Work Strategy is a range of initiatives that the government are introducing to promote and encourage remote work practices across Ireland. It was announced in January of last year, and there are a number of different components to it. This includes investment in remote work hubs. So the government are looking to perhaps offer a subsidy towards the cost of remote working hubs for people who are going to request remote working, but who may not necessarily be able to do that from their home. It also includes setting up a website for people so they can go in and they can book their remote workspace. The strategy also looked at different tax relief available to employees who want to work from home. And the budget for 2022 includes an increase in the utility tax relief that employees can claim. So this was 10% for heat and electricity, and that's been increased to 30%. The broadband remains at 30%. The National Remote Work Strategy also includes the right to disconnect code of practice that was announced in April of last year. And basically what this is, it allows employees the right to disconnect from work outside of the regular working hours. This can look different depending on the business, depending on the employee's job, but essentially it's the right to disconnect from work email, for example, after regular working hours have ended, or to switch off a company mobile phone, for example. So they're kind of the elements that have already been introduced with regards to the National Remote Work Strategy. And the key piece of legislation that everybody is very eagerly awaiting is regards to the right to request remote working. So it's in bill status at the moment. It's expected to pass into law beginning of the summer. Then what they're saying is before they go into recess, because of the current situation and ongoing events that are unfolding in the Ukraine, it's unknown if that's going to be the time frame, but that's what they're saying at the moment. So the right to request remote working bill. It's the first legal framework for requesting, approving or refusing a request to work remotely. So remote or hybrid work requests are essentially a request from an employee to work from a place different to their default place of work. So this could be from home or it could be from a remote work hub. The eligibility criteria that's set out in the bill at the moment is that the employee will need to have a continuous period of 26 weeks of service with their employer before they'll be eligible to submit a request. They need to give adequate notice. This is usually a minimum of 6 weeks. And they also need to include in their application specific information regarding their request. So they need to include things like the proposed location for where they want to work remotely from. They also need to include the proposed start date, and also included, which I think is really good for businesses and employers, they need to include a self-assessment as to why they feel their chosen or proposed remote work location is suitable from the point of view from an ergonomics perspective, from being able to protect confidential information, and from the point of view of health and safety. So I think that's an important element, and I think it's a good thing that that's provided for within the bill, and hopefully we'll see that translate into the law when it comes into place. The bill also includes a response timeframe and an appeals process through the WRC. So if an employee is either if they are not responded to within the allocated time frame, or if the employer does not give them a reason as to why they're declining their request, they will be able to take a claim to the WRC, and they will obviously bring the business in, and they will be put in front of them and have to justify their actions. What's interesting at the moment is that the appeals process does not include the right for the employee to appeal the decision that an employer makes. So if an employer refuses the request, there is no facility within that appeals process for the employee to appeal that decision. It is something that some parties are campaigning to have included in the law when it is passed. So it will be interesting to see if that is the case. So the benefits of hybrid working, I suppose the more that people were working from home during the pandemic, the more it became apparent that they had a more balanced work life. So they had the ability to go out and take a short walk on their lunch break. Some people can do this when they're working in the office, others aren't able to do that. But as well as that, it just meant that they had a bit more time for family, they had a bit more time for their own personal commitments, because they didn't have that time spent commuting. So that is really the main, I suppose, benefit for employees. But how does that then benefit, we'll say, how would that benefit the employer? Well, it benefits the employer because there's an enhanced employee experience there. And generally speaking, when there's an enhanced employee experience, there's increased motivation, which can then feed into your employee retention strategy. It also gives you the ability to encourage and attract key talent and retain that key talent in your business. So that is a definite benefit of hybrid working. But hybrid working also, research shows that in some cases it can improve the levels of productivity. So people may find that they become a bit too distracted when they're in the workplace, people coming to them, etc. So by having them, by working remote, they're able to concentrate and focus a lot more. Now, there is a flip side of that, and we'll have a look at that in a second. And then there's the decreased costs for businesses. So some businesses may be able to reduce the workspace that they need if people aren't going to be in the office all at the same time, because there's a lot of hot desking going on at the moment. So the days of having your allocated workstation do not necessarily have to continue. You can instead have people work at whatever workspace is available on the day that they're in the office. This can reduce costs from the point of view of workspace, equipment, office furniture, those kind of things. So they're the main benefits of hybrid working for a business, but there are some challenges as well. And these challenges can include things like communication barriers. So it's a lot more difficult when you're communicating with somebody who is working remote. You're relying on the phone, you're relying on video calls. And while they're all great, they are no substitute for that person-to-person contact and face-to-face contact. A lot of times communications can be misinterpreted when it's through email, and even sometimes on video Zooms and things like that. It isn't always easy to interpret people's body language unless you're there face-to-face. So that's a definite challenge for employers when it comes to hybrid working. Access to information is another one. So this can work both ways. But I suppose, like, how many times a day would you perhaps get up and walk over to somebody and give them something or ask them for information? Hybrid working prevents that, because you have to either scan something and email it to somebody, or you're saving it in a shared space in the cloud, for example. So it does impede, I suppose, the ability for you to have that face-to-face contact, the ability to walk over to somebody and give them and delegate something to them with regards to a task. And then there's the people management side. So the people management side includes things like being able to measure and monitor performance. So obviously there are metrics that you can put in place where they are very, it's very clear if somebody's meeting those objectives or not. But if you have an employee and you're concerned about their time management, when they're working remote, it's a lot more difficult and challenging for you as an employer to be able to measure their performance in that regard, and maybe identify the challenges that they're having and be able to support them more in that. And another example would be somebody who may be not using their initiative as much as you'd like, maybe not being as productive as you would like. Again, it's a lot more difficult to monitor that level of improvement or otherwise when somebody is working remote. So I just want to check in at this point and just see if anybody has any questions. Okay. So the grounds then for declining requests. So there are 13 reasons that, legitimate reasons that a business can decline a remote work request. I'm just going to go through some of those. And they include the nature of work does not allow for remote work. So that can be a very obvious one. If you have an employee who's in a job that needs to be customer facing, they need to be there in the premises, well, it's not going to be feasible for you to be able to approve a remote work request, and the bill allows for that as a reason. Another reason could be that you perceive a potential negative impact of quality. That may be because they're not, they won't have access to what they need in order to maintain and sustain the level of quality that's required for their job. Potential negative impact on performance. Some people need more of a micromanagement, and others are fine to be able to work away at their own initiative. If you feel that somebody needs that style of management and needs that level of support, that could be a grounds for you refusing their remote work request. Concerns about the ability to protect confidential and intellectual property. This is a very important one because from a business point of view, you've worked really hard, you've created a sustainable business and you want to make sure that every step is being taken to protect your intellectual property. That may be a legitimate grounds for declining a remote work request if you feel that cannot be, if you feel that information cannot be protected. Concerns about the suitability of the proposed remote working location based on health and safety grounds, or based on data protection grounds, or based on internet connectivity. So again, these are very legitimate reasons as to why a business could decline a remote work request from an employee if they felt that it wasn't a safe environment for them to be working in, if they felt that they could not demonstrate their ability to protect confidential and personal data, and if you felt concerns that their connectivity would not be reliable to ensure a sustained performance. In ordinate distance between the proposed remote location and on-site location. So like if you need to be able to call somebody at short notice to come into the office, and if they're not within a commutable distance to facilitate that, then that could be a reason for you to decline their remote work request. Ongoing or recently concluded formal disciplinary processes. I suppose as a HR consultant, I was very relieved to see that there, because I do feel that people who are either in the process or who have concluded that process, they need to be closely monitored. They need to be closely supported as well, because it can be a very stressful period for them. So I was relieved to see this as being a reason for an employer to legitimately decline a remote work request. So from a business point of view, how can you protect yourself against WRC claims with respect to remote working? So the legislation is going to require businesses to have a remote work policy, and that is going to set out exactly how the business will approach and manage remote work requests from individuals. So making sure that you have that there is really important, for the simple reason that the bill at the moment allows for a fine to be given to an employer who does not provide a written statement of their remote work policy to employees. So there's an obligation there. Once this comes into law and once it's effective, there's an obligation on you to provide new hires with it, existing staff with it, and the best practice guidelines would be to circulate your policy on an annual basis or when there are any amendments to it. Engage and involve the employee throughout the decision-making process. This will make sure that you're being open, transparent, and approachable with regards to it, and that will mitigate the risk of an employee taking a claim. And follow the best practice guidelines. That applies to anything that you're doing with regards to employment legislation. The best practice guidelines are there to protect you and ensure that you're doing the right thing for your employee, but also to protect your business from claims. A quick time check. Okay. So the other employment legislation that I just wanted to touch base on, because it is quite imminent, is the statutory sick pay scheme. It hasn't yet been finalised, and the initial drafts have raised some concerns, mainly around the cost for the employee to have to get a medical certificate, because to be eligible for statutory sick pay, it must be a medically certified absence. Initially, it's proposed that there will be 3 days statutory sick pay paid to an employee, and that this will increase gradually over the next few years and will probably plateau at 10 days statutory sick pay by 2025. The guidelines at the moment is that 70% of employees' wages would be paid by the employer, and that would be capped at €110 per day. For an employee to be eligible for statutory sick pay, they would need to be have 13 weeks at least length of service with the business, And as I mentioned, it would have to be a medically certified absence. Thank you very much for your attention, and thank you, Paul, for inviting me to be a speaker today. And Jackie, thank you very much for your support. I'm happy to take any questions now.
Thank you, Anne-Marie. That was a very comprehensive presentation, and
Thank you.
it seems to have answered all the queries that people have been looking for, because there is no questions popping up at this time.
Great. If there is anything anyway, they can pop it into the chat or into the question and answer.
Okay, so next up is Anne-Marie Russell. Anne-Marie Russell is the Development Advisor at Enterprise Ireland. She's extensive experience in business strategy, operations and international scaling. She specialises in engagement with client companies that have an ambition to export, businesses that are focused on growing their existing exports, or those that are at an early stage of export planning. Working across a diverse range of industries, Anne-Marie identifies the right supports for client companies based on their specific stage, circumstances and growth trajectory. Look forward to seeing Anne-Marie's presentation.
Now, sorry, I'm just going to check for sound. So good morning, everybody. I think I was on mute there for a minute. And my name is Anne-Marie Walsh. I'm delighted to be part of the Paul O'Donovan's business event this morning, and appreciate the opportunity for Enterprise Ireland to talk through some of our supports, which I hope will be applicable to you. Enterprise Ireland this year, we launched our new strategy called Leading in a Changing World, and I have a short video on that now.
Everything evolves. Our environment, the economy, the markets, everything changes. And that change is accelerating. To survive, we need to adapt. But to thrive, we need to lead. And Enterprise Ireland has a plan to help Irish businesses lead through these times of change and opportunity by creating the best environment for world-class innovation across Ireland, by guiding our exceptional entrepreneurs and enterprises to further global growth, by adapting to climate change and turning challenges into opportunities for our clients, by creating the right conditions for our talent to spark innovation, and by embracing the possibilities of a digital future, and by delivering world-leading service to our clients, agile, responsive, and collaborative. The future is unwritten. The world will continue to evolve, but together we'll be ready to steer and shape it, ready to lead. Enterprise Ireland, leading in a changing world.
So I hope that video plays okay for all of you. So just to, I suppose a part of our strategy is that we have a target that by 2024 that Irish companies will be exporting 30 billion euros. So as an organisation, we work with companies who are either currently exporting or who are considering exporting. And the type of clients we work with are involved in manufacturing, technology or internationally traded services, and also are currently employing 10 employees or more. Now, as an organisation, we have a wide range of supports, and I'm not going to go through all of them here today, but we do work with all companies of all sizes, so small, medium and large companies across all the different sectors, and we have a lot of expertise within Enterprise Ireland. For companies, regardless of where you are in the country, your point of contact would be your regional DA, development advisor. And at the end of the presentation, I'll show you where you can contact that person. So starting off, we'll start light. So we run webinars on a continuous basis on various different topics. And the best way to find out about them is to go onto the enterpriseireland.com website, log on and register for a newsletter, and that will keep you updated. There is one particular webinar I'd like to bring your attention to, and that's the Export Compass series. That is a series of 5 webinars. It's currently available on the Enterprise Ireland website. You can just register for it, and it's ideal for any company who is either considering exporting or maybe who's currently exporting with 1 client or 2 clients and looking to grow. So if you're looking to develop an export plan, this Export Compass series will talk you through that step by step. So it's a really good overview for you and your team to have a look at. And of course, all good export plans start with market research. And I think anybody who's been successful in exporting will say that the more research you can do at your desk, you're really de-risking that export plan. So the Market Research Centre, or the MRC, has access to journals and reports across all the different sectors. Some of those reports, you know, if you were to buy it, would cost over $1,000. So there's a lot of value there. You contact the Market Research Centre, tell them what you're looking for, and they'll support you on that. And that's also, if you're looking at product innovation, you're looking for information on in that area, they'll support you on that. So really great resource that's there. If you're a Leo client, you go through your Leo advisor. Just to bring you down to here to the EI Learn, that's our online platform, and it's where we have tailored leadership and management development programs. Some are short, consisting of a morning, and the longer programs are really geared for the CEO, senior management team to bring on your capability and your development. And it's a fantastic resource. I would highly recommend that you have a look in at it, and the programs are run throughout the year. One particular program that we receive fantastic feedback always on is the Business Planning Navigator, and this presentation will be shared with you later, and there's a link there to that page. And the Business Planning Navigator is really in response when we go out and meet companies. When we get talking to them, we find that a lot of them have business plans, but some of them are in the heads of the founders and the owners, which is great, but really it works much better when it's documented and shared amongst the senior team. And this Business Planning Navigator will do that for you over 8 weeks, where you're working in it's a mix of workshops and one-to-one with the consultants. So it's a really fantastic resource at €300. It's a really, I can't recommend it high enough. And in fact, we have a lot of companies, large and small, who come back and use that as the kind of structure, the architecture to get their business plan reviewed every couple of years. So very good resource. What we're hearing on the ground from a lot of clients is, of course, big issue around recruitment and the costs. And Enterprise Ireland has 2 really great supports. The first is the Grad Start, and the Grad Start support is where Enterprise Ireland, we want to encourage companies to take on graduates, and a graduate can be somebody who has graduated within 4 years. We support 50% of their salary for the first 2 years, up to 15,000. So that's a 30,000 grant support, really fantastic. And now there's some restrictions around it, like it can't be for a sales role, and the graduate can't be currently working with you. But again, contact your development advisor for more information on that. The Key Manager Grant is something I love to see coming through, because it really means that the company are really taking a step change in how they're looking and how they want to grow their business. It's about bringing in that strategic expertise into your business. And again, it's a 50% support for 1 year. But really it's looking when you're thinking of saying, okay, I want to bring in a chief financial officer or a head of production, that kind of a expertise that's going to drive a significant change in your business. So another great support there, just to make you aware of that. Moving on, the Lean Business Offer. It starts with a digitalization voucher. You might say, what's that doing there? But actually, digitalization and lean are two sides of the one coin. So the digitalization voucher is to facilitate that strategic intervention in your company, bringing in a third party, an outside consultant, to assess where you are in terms of digital maturity and putting together that roadmap or that plan for the next stage, identifying those roads for improvement. The Lean Start as a support on its own, again, is one that you can use to introduce lean principles into your business, and also identify maybe areas of support. I had a client who used it, and they brought in new equipment, and they brought in a lean consultant to help them to figure out configure the new workflow. So, you know, a small project, but a great support for that company. An example of, I suppose, of the digitization voucher and the Lean Start and the Lean Plus working together would be, I had a client who's looking at implementing a new ERP system. And anybody who's invested in that knows that it's a substantial investment, not just financially, but also in terms of time. So what we advised them to do was to apply actually first for a Lean Start. And the Lean Start would be that they would start working with a consultant who would map out the process that the ERP system was going to operate for them, and do that in the most lean fashion. So it was really giving them a clear specification as to their requirements. They then applied for the digitalization voucher, and working again with the same consultant, that consultant was able to identify the best fit ERP solution to meet their needs. And then they applied for a Lean Plus support, and that gave them 50% support on the implementation of the ERP system. And as anybody who's been through that will know that it's a considerable drain on internal resources, and also the cost then of using external consultants. Now, the Lean Plus in that stage would not pay for the ERP system itself, but it's all around that implementation. So really a significant Lean project for that operation. And of course, the Lean Transform, then that's a much bigger company-wide transformation. You're really bringing in that lean culture into your operations, and you're including digitization in that. So that's reviewed on a case-by-case basis. So moving on. Climate action, very topical at the moment. John mentioned it this morning. Energy crisis really around oil and gas. And of course, what we're also hearing on the ground is that business clients are saying that their customers are asking them about their sustainability plans when they're procuring products. So, you know, it's kind of a push down from the top. So the aim of the Green Programme is to help companies really incorporate sustainable practices into your businesses. And of course, we're after, you know, really with the end goal of reducing costs, increasing competitiveness, and making you more kind of agile and resilient to what's happening at the moment with climate change. So the Green Start, the Climate Action Voucher, again, is that first step on the stairs. A consultant come in, do an audit. That voucher covers for a 2-day audit, and then you're coming out with an action plan or an identification of areas for improvement. So, for example, very pertinent at the moment, you could use that climate action voucher to do an energy audit on your business, and from that then the action plan will identify where you could go. So you might end up going to the SEAI to look at some of the supports there, as well as the Green Start support. The Green Start then more around the systems and the structures, and you can look at the carbon footprint of your business. So back to that question from a customer, if they're looking at where are you sourcing your materials, the Green Start is a support around that. And then the Green Plus is really around that more, you know, developing that sustainability plan, business plan within your business, and the costs there are related to training, for that sustainability plan. I put in here a link to the climate toolkit for business, and that has been developed by government agencies and government departments, and it's designed to give you a simple, easy to use carbon assessment for your business. So it's a good support to have as well. also included more detail on specific sectors. So if you're in the food and drink, manufacturing or ICT, there's some really good links there to webinars that we've held, and we're allowing you to access those, and they go into more in-depth detail, as well as some people talking about it as well, companies who have used those supports. Of course, this week and yesterday was International Women's Day, and we had that hashtag Break the Bias. Enterprise Ireland has a project that we launched last year called the Level Project, and I'm just going to play you a short video just to give you a flavour for what it means.
Gender balance is important in leadership teams because it gives you that breadth of perspective that's required for critical decision making. Here at Modular, we're developing custom automation solutions for the medtech sector, and that involves delivering innovation for those customers, and that innovation requires different perspectives, different ideas, which you can only achieve with having strong gender balance. One of the
So sorry, that video goes on, so just cut it short there. So the Level Project is, again, there's a toolkit available for that. So if you want to have a look at the Level Project toolkit, it'll walk you through, ask you some questions, information you'll put in, and out of that then you'll get that roadmap. So how supporting you, the steps that you need to take to implement the Level Project within your company. So really it's about achieving gender balance within the senior leadership team. Now, I've put two supports here at the bottom that I just wanted to link to that, because out of that toolkit, you'll get that roadmap. And to support you in that roadmap, we have strategic consultancy. So that is where you have an opportunity to work with a consultant over maybe 3 to 5 days, and they can support you around one of the areas in your business. So for example, if out of the toolkit, it came out that your job descriptions needed reviewing and your whole recruitment process, you could work with a HR consultant such as Clodagh to support you implementing that action plan into your business. And that consultancy support, depending on the number of days, can go between 50 and 80%. I've included here as well attracting and retaining talent program. That's a general recruitment kind of attracting and retaining talent program, general program that we're running online, and that program is running the 24th of March and also in April, and I think there's one also booked in for May. But again, you can look on the website for information on those. But again, very good supports. So for any company who is on the cusp of exporting and saying, where do I go next? A support that is very, we get super feedback, is a strategic marketing review. And if I could summarize that support as it does lots of things, but what it really is going to do is change the way you think about your customers and your markets. And it's going to support you in differentiating yourself in a competitive market landscape. So the strategic marketing review is a 10-day program working with a consultant to bring you to that area, to look at moving into your export markets. I suppose the next step from that is the Market Discovery Fund, and that's really about coming out of the strategic market review. You're going to be very clear on who your market sector is and who is your customer, and the Market Discovery Fund then will support you in the research and exploring that marketplace that you have clearly identified. So it's when you're moving into either a new market with an existing product, or you might be currently in an existing market and you want to bring in a new product, and that MDF fund is there to support you. The business process improvement is focusing on developing management capability around the lean, environmental or business processes improvements. and I declined to use that support recently. They were very strong with their online sales, and they were really wanted to grow that side of their business and really get to be the cutting edge of marketing and developing that side of their business. So they applied for a business process improvement grant, and they worked with external consultants who gave them in-depth training and support around developing that side of their business. So it really was a substantial good support for them. I can't go without mentioning the business financial planning grant. This is a grant that was implemented as a result of COVID, and when there was a lot of changes happening for business, a lot of challenges, and that grant, which is 100% funded, was so successful, and we received such great feedback on it that we've continued to run that to support the business financial planning grant. So if you are a company and you have immediate liquidity issues, or you want to go and secure finance either externally to the banks, or maybe you're looking at the first stage of looking for a capital investment with Enterprise Ireland, or you want to put up a framework to manage your finances of your business, this is the grant for you. It's as I said, it's 100% funded and a great support. The innovation is a key aspect of our strategy, and again you can see it starts there with the innovation voucher, which is the first step of the ladder. If you have you want to explore a business opportunity or a problem that you have, right up to the innovation partnership, which is where you would engage with a third level institution who would research a piece of work specifically for your company. So lots of support there, and I know Paul spoke to me earlier on about companies he's working with who are using the agile innovation. So these are great supports for your business, and and also to mention the operational excellence, the support around there I particularly wanted to highlight was the capital investment initiative. So that funding level depends on where you are in the country, but if you're looking at investment in making investments in capital, please do look at that capital investment program. The strategic consultancy is another support that we provide, and that works with companies, as I said earlier on, for anywhere from 3 to 5 years. The short one, which is 3 to 5 days, and we have a longer one which can run over 12 to 18 months. So the shorter support is based across the 6 pillars that we talk about in Enterprise Ireland, and that is strategy, finance, innovation, sales and marketing, people and management, and operations. And on any of those pillars, you can look for support under any of those pillars, and that would be your 3 to 5 day support. The longer support is an example is a company who are growing very fast, and they've made great way in such a short space of time, but the founder obviously is conscious with it's great growing at a pace, but it's also comes at risk as well. So he has applied, they've applied for the strategic consultancy, and they're working with a consultant who's going to stay with them for a 12 to 18 month period. And so it'll be a mix of mentoring support, financial support, and general business support to ensure that his business grows in a sustainable manner. We also have mentoring support, and another client is using that, CEO actually, using that support for one-to-one mentoring support for themselves. So I suppose when you think of EI, lots of people tend to think of funding and the grants, but actually over 60% of our client companies came back and said it's the other support, it's the expertise that really they really liked about working with EI. The HPSU for any company who has, I suppose, who's an early stage or an entrepreneur has a business idea, the HPSU is the High Performance Startup Unit, and that's where support is given in a very condensed way, and it's looking to grow your business at a fast pace. And what that pace means, it's €1 million turnover within 3 years and 10 staff within 3 years. So now there could be some companies who are on the call who maybe are developing a new product. One company who's in a very traditional marketing, delivering a traditional product and service, but they've identified a tech product and that has the potential, you know, and they are looking at the HPSU as a potential for that, so it'll kind of be a spin out of their main company. And before I go, I just wanted to say the job expansion grant, if you are a company and you're looking at growing at a fast rate and your possibility of taking on a number of staff, there is a support around the job expansion fund, and we'd love to talk to you on that. Okay, and then just finally, that's a map of Ireland where our offices are located. So no matter where in the country you are, please do reach out to your local Enterprise Ireland office and speak to us. We'd love to hear from you and bring you on board as an Enterprise Ireland client. If you are with the local enterprise office, the route then would be to contact your local enterprise advisor, who will put you in contact with Enterprise Ireland. Thank you very much. And if you have any questions, please work away.
Thanks, Anne-Marie. That was a very comprehensive presentation. And as someone who has been working closely with Enterprise Ireland over the last number of years and a mentor on their programme, I'd like to congratulate Enterprise Ireland for the supports that they've given the Irish SME and continue to do so into the future. So we don't have any questions at this point, so we'll move on.
If I could just add one thing, which is I went through the climate action supports, but just to say that there are new supports coming down the line, so that are particularly geared towards more capital on the capital and infrastructure side. So just for any company who is thinking of that, I would suggest that companies would start that engagement process with Enterprise Ireland now and put themselves in good stead to be able to embrace those supports when they roll out, which we would expect to be in Q2 of this year.
There's no further questions, so we'll move on to the next presentation at this stage. So thanks, Anne-Marie.
Thank you.
So at this stage, I'm going to move and talk about planning for succession, retirement and pensions. And the first, to quote for a famous footballer, if you fail to plan, you're planning to fail. And so one of the obstacles we always find is that people should always be looking at their exit when they look towards commencing their business. So as they commence the road and the journey in their business environment, they should also look at what is their exit plans and how they're going to bring them to fruition. It's very important that one exits their business in a most tax efficient way, and they need to plan well in advance with family, key staff members, financial advisors, pension providers and accountants. At the outset, what we have been finding in the last number of years is that people are looking at the executive pension plan and looking at tax efficient ways of extracting money from the business and commencing a positive executive pension plan at the outset. An executive pension is a company pension plan that's set up by a limited company for the benefit of its company directors, owners and key employees. Both the employer and employee can contribute and avail a tax release paid by the company. The standard fund threshold is 2 million. What we have found in the last while is that a lot of the company pension plans were underfunded, and as a result, people have looked at the max funding investment that can be made by them to bring their pensions up to date. And this has never been more so than in the last number of years, when effectively, and particularly over the COVID time, when people have been looking at saying, where do they actually stand at this stage? And, you know, what is where the business is at, where are they at personally, where their pension is at? And there's been an overview of everything going on in the last number of months. The key benefits here is that it's tax efficient. There's a high scope for contributions for the directors of the companies. It's flexible, security, because the money is ring-fenced money in their own name. There's a choice of funds and investments, and retirements as early as age 50. Withdrawing from pensions, there's two options. Option A is a once-off lump sum of 25% of the value of the fund, subject to a maximum tax-free lump sum of 200,000, with the next 300,000 taxed at 20%. So therefore, if you reach the optimum of 2 million, effectively you would have a tax-free lump sum of 440,000. The remainder of the fund then would be invested in an annuity or an approved retirement fund. Option B is where somebody is on a high salary base and there's a lump sum maximum of 150% based on that salary. So if they have a high salary base and their pension contributions are not as strong, they could take out 150% based on salary and service, subject to a maximum lump sum of 200,000. Again, with the next 300,000 taxed at 20%. The difference there is that the remainder of that fund must be invested in an annuity. So along with maximum fundings of your pension, you will also need to plan years in advance so you can retire or dispose of your business in the most tax efficient way. Here you will be looking to reduce or eliminate your capital gains tax exposure, which currently is at 33% of disposal. There's two reliefs available that can gain relief on the capital gains tax. One is retirement relief, which gives you full relief to capital gains tax subject to certain conditions. And the other one is entrepreneurial relief, which brings your tax liability from 33% down to 10%, again subject to certain conditions. So the conditions involved in retirement relief, the overview is the capital gains tax arises on the profit you make in the sale transfer of a chargeable asset. The rate, as I said, is 33%, and there's full relief on the 33% when claiming retirement relief and disposal of part of qualifying assets. Qualifying assets are the chargeable business assets, which are typically in the trade or profession, land, buildings, plant, machinery, goodwill. And the second category is shares. So if we were selling, we've just completed the sale of a business for a long-standing client who sold his shares, and effectively both of them qualified for entrepreneurial relief, and both of them qualified for retirement relief, in the first instance, and effectively they got their money out tax-free. We also completed the sale of a business where there was the sale of shares as well, and effectively in that instance they qualified for entrepreneurial relief, and the saved tax was substantial. They were taxed at 10% instead of 33%. In the retirement relief qualifying conditions, the assets must be held for a minimum period, which is usually 10 years. You don't actually have to retire fully from the business, as you're still allowed to be employed in the company after you retire. You must be 55 years or older on the date of disposal, and the relief available if under 55 if there is certain health reasons. You must hold at least 25% of the voting rights, and you must be a director for a minimum of 10 years prior to disposal and deemed a full-time working director for at least 5 of those 10 years. That's a very sticky rule, and it means that the person must be employed full-time as a working director in that specific company. The retirement relief disposal to a child, full CGT relief on the disposal of qualifying assets if aged between 55 and 65. The relief then is restricted to 3 million if you're over 65, with any excess of 3 million liable at 33%. So again, the planning of age profile and when you're going to succession planning brought in place, if you're going to pass down to the next generation, it's very important that you look at these rules and ensure that you're meeting within the guidelines. Because again, if the business is done exceptionally well, then planning to succeed to the next generation, 55 to 65 years, means that there is full CGT relief on the disposal. There's a clawback on the relief then granted if the child disposes of the assets within 6 years of they becoming in control of them. This is payable by the child along with additional capital gains arising on their own disposal. For the purpose then of disposal to a child that can be referred to as son, daughter, stepchild, adopted child, child of a deceased child, niece, nephew, who have worked full-time in the business for at least 5 years, and foster children who were maintained for at least 5 years before they turned 18 years of age. So communication and planning with the proposed disposal to a child is imperative to ensure they're on the same path and reduce any inheritance tax liabilities. Again, we just completed a situation where father has passed on 48% of company to 2 sons, and effectively there was no exposure to capital gains tax, and the 2 sons were liable to 1% stamp duty on the value of the asset transferred over. And effectively that became a very tax efficient and benefited way to bring the sons involved into the business. Retirement relief to dispose of someone outside of the family. The relief is still available if you dispose of your business to a person outside the family, but with different limits on proceeds depending on age. There's a relief up to 750,000 if you were under 66 at the date of disposal, but this falls to 500,000 if you are over 66 or older at the date of disposal. The same retirement relief conditions are met as before. However, if the sale is above the 750 or 500,000 threshold, you may be entitled to marginal relief. The market value of the business is above the threshold. Marginal relief will mean that you are liable to CGT on 50% of the difference between the sale value and the relevant threshold amounts. Both thresholds are lifetime limits. And as a worked example on this, Peter, who owns 100% of ABC Limited, has been a part-time working director for over 10 years prior to his disposal. He's now 54 and decides to sell his shares in the business for 720,000. Peter's position is calculated as follows. The sale price is 720,000. The allowable expenses are 75. So he's a chargeable gain of 645. Again, after taking a personal allowance, taxable gain is 643,730, and a 33% CGT is 212,431 euro of a liability. However, if Peter planned his situation and sought advice on his retirement, he could have saved all of that liability. During his succession plan, he would have received advice to wait until his 55th birthday to make the disposal and ensure that the full-time working director of at least 5 to 10 years prior to his disposal. Peter's CGT position would now be nil, and he would qualify for full retirement relief. And this is because Peter would have planned in advance of his retirement to make sure that he is meeting all the conditions to avail a retirement relief. Again, if Peter sells his shares for more than the 750,000 and he sells for 900,000 and again waited until his 55th birthday, he would be liable to CGT of 50% of the difference between the 750 and the 900,000 proceeds, which is 150,000 at 50%, which is just 75,000. In this instance, Peter would have saved 137,431 euro. Peter would he would be entitled to full retirement if he disposed of his shares to a child, as he would have met all the qualifying conditions, and he would pay no CGT on this disposal. So again, planning is key here. Talking, communicating to financial advisors, again, is paramount, and making sure that you're getting the right advice. It leads to saving substantial sums of money. And again, there is no point in paying out unnecessary tax when effectively with the proper planning mechanisms in place, you can save those tax liabilities. Entrepreneur relief. This works like retirement relief, where it can be applied to capital gains tax bill. In this instance, it reduces the rate of CGT from 33% to 10% on the gains of disposal of your business. There's a lifetime threshold in Ireland at the moment, currently at $1 million. Again, the UK have a threshold of 10 million in this instance. So again, depending on the government's stance on this, it's something that needs to be looked upon, because the $1 million threshold, lifetime threshold, is too low, in my opinion. Entrepreneur relief does not apply to the disposal of the following. So shares in securities and assets held in investments, but it does qualify where you have qualifying relief for trading shares, then yes, you do qualify there. It doesn't apply to development land, assets on disposal of which there's no chargeable gain, assets personally owned outside the company where such assets are used by the company, goodwill which is disposed to a connected company, and shares of security in a company where the individual remains connected with the company following the disposal. Entrepreneur relief conditions then is that you must own the business assets for a continuous period of 3 years. So unlike retirement relief, the period of ownership is 3 years instead of 10. The 3 years must be in the 5 years immediately prior to disposal. The business assets must be used for qualifying business, and qualifying business assets would be shares held by an individual in a trading company or owned by a sole trader and used in their trade. You must have been a director or employee of a qualifying company or companies in a qualifying group. In the case of shares, you must have owned at least 5% of the ordinary shares in the company for a continuous period of 3 years. And the 3 year period can be at any time prior to disposal. And you must have spent no less than 50% of your time in the service of the company in a managerial or technical capacity, and in that capacity for a continuous period of 3 years. So unlike retirement relief, you don't have to be a full-time working director, but you must spend no less than 50% of your time in the service in a managerial or technical capacity for a 3 year period. Again, a worked example here. John carries on a business as an engineer. He sells his practice premises and goodwill to another engineer for 700,000. John bought the practice premises for 300,000. John should be in a position to claim entrepreneur relief in the sale, and his CGT position is calculated as follows. So its sale price is 700,000, the allowable expenses are 325, leaving a chargeable gain of 375, and that taxable gain becomes 373,730, and at 10% his liability is 37,373. By availing of the entrepreneur relief, he saved 85,958 in capital gains tax. Again, as I said previously, you have a situation where we were involved in a sale of a company recently, and they sold the shares to another entity and effectively availed of entrepreneur relief and saves, again, 23% of the sale price in tax. There's reliefs available on liquidation. And if so, for whatever reason, you decide to liquidate the company as opposed to selling it, you may also be able to claim one of the reliefs. Retirement relief and liquidation is where the assets are sold not more than 6 months prior to the appointment of liquidator. The proceeds of liquidation can be treated as a chargeable business asset which qualify for retirement relief. Again, looking at it, we have done a situation where we've put a holding company above 2 subsidiary companies, and as a result, we brought the children into the company, into the holding company, whilst the parents stayed involved in the company, so they transferred 50% or less of their shares to the children. And then they decided to sell the remaining shares that they had back to the company. And by doing so, they qualified for retirement relief for the 750,000 share back to the company, and by redeeming their shares, and they qualified for the retirement relief to the children because the proceeds were they were between the age of 55 and 65, so they were exempt from capital gains tax. In that instance, then the child by default owns 100% of the company because the parents have redeemed their shares back to the company, and they've taken their money out tax-free. So again, with the right planning in these instances, they can show that very significant tax savings can be made and ensure that the person exiting the business has achieved a substantial reward for their efforts of running the business for the period of time that they were in it. Entrepreneur relief and liquidation is also available once the liquidation is completed within 2 years from the appointment of liquidator, and the relevant company carried on the qualifying business up to the appointment of the liquidator. Relief should be available provided the other conditions are satisfied and the company is still trading prior to the appointment of the liquidator. The relief would not be available to the liquidation of a holding company, as the holding company would not have carried on a qualifying business prior to the appointment of the liquidator. Again, in relation to other considerations and other tax efficient methods that need to be looked at, one of them is termination payments. So again, prior to disposing of the shares in the company, the clients who would have availed of a termination payment in their employment and got that out tax-free, and effectively then continued with the disposal of their shares and effectively avail of their entrepreneurial or retirement relief, depending on the circumstances. Advanced planning and communication with key staff members, advanced discussions with potential successor and our family members, your succession timeline, and finally, your business valuation. It's very important before any exit that you understand how much your business is worth and how you're actually performing in your business. So getting business valued is paramount in moving forward towards an exit and understanding where the business growth is and what its value will grow to, so that effectively you can take the necessary steps to utilize your max funding for pension in extracting cash, if that's the case, and equally finding yourself in a situation where you can attract a potential successor and our family members to take over the business while allowing you to avail of retirement stroke entrepreneurial relief. Okay, if anyone has any questions, I'm happy to take them now. Thank you. Okay, so moving on, our final speaker today is John Mullins. John is an executive chairman of Armarenco, a fast-growing company focused on development, financing, and ownership of solar PV assets in Europe, Caribbean, Middle East, and Asia Pacific regions. Previous to this, John was chief executive of Bord Gas, and they established a significant electricity business and developed significant renewable and conventional generation assets. He's a fellow of the Engineers of Ireland and an Irish Academy of Engineering, who has a master's degree in electrical engineering from UCC, and had the privilege of being in college at the same time as myself, and we spent many good times in the main rest and the college bar. So looking forward to hearing John's presentation. Thanks, John.
Hopefully you can hear me, Paul. Good morning to everybody. Yeah, great. Paul, thanks very much for the invite, and also to Jackie and to all the staff, wishing you all the very best in your company. And also to all of the attendees this morning, wishing you all the very best as you're coming out of COVID-19. And there are parts of the world where they're all still wearing masks and doing PCG testing, as I've attested to over the last number of weeks, traveling in the Middle East. But here we're fortunate that we're coming out at the back end, but clearly we're entering a very different world, a world which has got an enormous amount of risk and volatility attached to it. And I think John Finn spoke to it eloquently earlier on when he talked about hedging. In fact, actually this morning, I was just asked in the middle of this, we should actually hedge Singaporean currency actually, and I had to send an instruction to do so in a hurry. So things are moving all of the time, but one thing I think that we all agree is that we do care about Ukraine, and Slava Ukraini is the first thing I'd like to say this morning. Because I had visited Ukraine on a number of occasions in business. I know a number of people who live in Kiev, and certainly my thoughts and prayers are with them and with all of the children and the women who are now struggling to get out of there. And I think our thoughts are with them. So I think we really want to start with that, because I'm going to be talking about climate change, but I'm also going to be talking about ESG and why it's important. And in the context of what we're living through at the moment, it is extremely relevant. And it probably wasn't relevant, as relevant, Paul, when you invited me to speak, but quite clearly this morning, it is. So I'm going to speak about the global challenge that we're facing, an introduction to where we are as a company, headquartered out of Cork. I just want to make a couple of points on Irish energy policy, because I've been working in the sector for 32 years, 33 years this year, and ESG, why it's good for your business, and just to convince you that you should look at some of the Enterprise Ireland supports that are emanating in terms of climate change investment, but also what's important from a social and governance point of view. And I just want to give you a flavour as to what we do about ESG, because any company thinking of attracting in institutional finances we do, or listing a company, or even getting bank finance in the future, are going to have to show non-financial credentials. And I think I would say that Paul's business probably in the next 5 to 10 years will actually have a non-financial audit function, which will be looking at ESG in particular, because people will be insisting that we as businesses do things ethically, morally and properly. I just want to start with pictures that some of us would recognize from around 2009 on the right-hand side, but now the 6th IPCC report is out. So it says that human-induced climate change is causing dangerous and widespread disruption in nature and affecting the lives of billions of people around the world. And down at the bottom, it says, the world faces unavoidable multiple climate hazards over the next 2 decades, with global warming of 1.5 degrees Celsius. Even temporarily exceeding this warming level will result in additional severe impacts, some of which will be irreversible. Risk for society will increase, including to infrastructure and low-lying coastal settlements. I know a lot of people in civil engineering department in UCC, and they have studied the impact of climate change and 1.5 and 2 degrees on our region, and it is an ever-present threat to our region. And many of our businesses, like my own, are based in the city centre. That we will see a lot more flooding, we will see a lot more weather events, and we will certainly go over 1.5 degrees at this particular point in time. So the onus is on all of us to make a contribution as people, but more importantly here this morning as businesses, to address the greatest global challenge, which is basically climate change. If you look on the left, we have 3,000 days to have the emissions to unwind 50 years of unsustainable growth. And this is all emanating from various COP conferences. Next year's COP conference is in Egypt, where we have a business in Cairo. Certainly COP27 will have to take the issues at hand more seriously than it was taken at Glasgow last year. You can see on the right-hand side that it's not just about climate change, it's about land system change, it's about biogeochemical flows, it's about novel entities, it's about the loss of flora and fauna. And any of us who have seen various documentaries by David Attenborough and others have seen what the impact worldwide has been of climate change. Even a single 0.5 degree increase can have devastating effects across various regions. So as David Attenborough says, we need to basically, we need to move from being apart from nature to becoming a part of nature again. And at the bottom, regenerative development asks us to imagine cities, towns, and villages that possess greater natural beauty, ecological health, and productive capacity than even the world's most pristine forests. Now, I have to say, you know, on and off, I've been living in Cork City for the best part of 54 years. And frankly, I don't see that about our city. And I think it's something that we as a people and businesses certainly need to push forward, to have more green space, to have more sustainability in our city, and to be a first-tier example of what we actually need to do in the new paradigm of climate change challenge. In terms of greenhouse gas emissions globally, energy accounts for 73.2%. And clearly in terms of energy in industry, transport, and energy in buildings, that dominates. In Ireland, by the way, agricultural, as you know, emissions are over 30%, primarily because we have over 8 million cattle, and we have a very healthy dairy and beef industry and sheep industry. And clearly, that's a big challenge for us to reduce the level of greenhouse gases in the next 10 years. And the government has produced some significant targets. But as was indicated earlier, some of the things that we can do is actually insist on buying green energy. You can get green electricity, you can get green gas from the suppliers out there, whether it be Electric Ireland, Iberdrola, SSE, or Borgash Energy, or Energia. They do offer the option to buy green energy. And I think for companies, it's important that you actually state in your website, state on your annual reports, that you actually have, 1, sustainability targets, and 2, this is how we're actually going to achieve them. Because people look at that in terms of the ethic of your business, the brand of your business, the values of your business. And fundamentally, this is now becoming a pre-requirement for businesses to conduct in the Western world, and also we're now seeing in Asia and also in the Middle East that these particular concepts are being taken on quite significantly. Armarenco, well, we're based on the right-hand side. You might recognize the building. It's 11 Anglesey Street, straight across from the Garda station. That's our global headquarters. We're headquartered out of here, but we have about 220 employees worldwide now. We were established in 2013 with 4 people. We've raised over 1 billion euros of equity and debt over this period. We're a mixture of French and Irish shareholders. Originally Irish shareholders, and now we have companies like Clodagh, the bank, and also Tikehau Capital in Paris. And we're in the middle of a major fundraising through Paris at the moment as well to meet all of the pipeline that we have across the world. We're currently operating in 14 countries and we'll be moving to 16 countries presently. Our revenue last year was about 78 million and our EBITDA was about 13.5. We're moving to 117 million we expect in 22 and about 34 million of EBITDA. So it's a rapid growth. Clearly, maybe out of a crisis, certain companies are going to benefit. Clearly, solar power and solar generation and renewable generation and the accelerated move to renewable energies to counteract our dependence on Russian gas, for example, is quite definitely going to improve our business here in Europe, but we're actually growing in other markets as well. These are examples of our projects, 50 megawatts south of Seville on the top left. We're building a 105 megawatt lithium ion storage. That's a lot of battery. In Luz 1, 2 and 3 in Portugal, we're developing 312 megawatts at the moment. We have a significant partnership with Total in France on commercial rooftops. We don't do commercial rooftops in Ireland. There is no tariff for it. And in Solar Wadi in Oman, we just took ownership of 1.9 million square meters where we're putting our first 100 megawatt plant, which will provide direct power, decarbonized power and cheaper power to an industrial city in the port of Sohar, about 2.5 hours north of Muscat or 2.5 hours south of Dubai. In terms of Irish energy policy, I just want to say a couple of things about this. In the middle of 21 on the left-hand side, I made commentary to RTE about the importance of getting LNG in Ireland. At that time, I was talking about a post-Brexit position where essentially there is no treaty between Britain and Ireland. As you can see, Britain is doing things for themselves now. And frankly, if we're in an emergency, there is no assurance to the 2 pipelines coming from Scotland that we're going to get supply of gas. Corrib is actually depleting. Kinsale gas is decommissioning. We have no other source of indigenous gas. Maybe Barry Rowe might come on. And again, we have a lot of, I would call, newly found eco-socialists in this country who fundamentally are going against anything to do with the importance of transition fuels in Ireland. As a previous chief executive of Bord Gáis, it was my role to steward gas in Ireland for 5 years. And certainly in that period, I was particularly concerned about the security of gas. Now compound that with what we have with the guy on the right-hand side on his horse, we have a big problem. It's a serious problem, and it's a problem that basically ideology, and particularly eco-ideology, needs to be thrown out the window, because what's more important is actually that we have sustainable an economy, we have sustainable energy to all of our businesses, because we had 5 amber alerts last winter. The IDA are extremely concerned about this, and that means that if one more power plant went, we would have had blackouts. This is an unsustainable situation. It's a situation whereby many of my projects and other people's projects are wrapped up in bureaucracy and legalism in this country. We need more renewables quickly. We need more planning priority, and we need to install LNG. And by the way, I'm not the only person saying this. If you look at Ursula von der Leyen's commentary last night, I actually relinked it last night. You will see she's saying exactly the same thing as a result now of the guy bare-chested on the horse, who basically is fighting a war which fundamentally is wholly unjust. In terms of our business and in terms of renewables, you can see based on Bloomberg New Energy Outlook 2020, solar and wind by 2050 is going to dominate. It's going to be 56% of all energy. You can clearly see for our business and other businesses like us, it is exponential, the level of growth, and exponential, the level of capital investment needed in sustainability. In that, there's great opportunity for businesses to provide services, for businesses to invest, for banks to invest, for pension funds to invest in these particular assets. So it is a significant opportunity, this transition economy, and something that I hope many of your businesses can embrace as you go forward. We're very fortunate, by the way, in Cork now that we have companies such as Brookfield, we have Ørsted, we have Statkraft, and we have Armarenco. 4 of the largest European players in renewables are now based actually in Cork City. So I just want to talk for a period about why is ESG important, what is ESG, and what can it do for you as a business. And I'm just going back to the point of really, buying energy is only one aspect of what all of this is about. It's also about social interaction. It's also about how governance is done. It's about gender equality. It's about diversity of culture. There's a lot involved in this, but one of the things you see from, and again, I've put this up and Paul can hopefully share this with all of his clients, but in terms of ESG matters was a paper produced in 2020 by the Harvard Law School Forum on Corporate Governance. And in this, they showed that people on the left of the chart who have low ESG performance have lower levels of EVA margin, that's enterprise value add. And those on the top end of ESG performance basically have much better returns. And to that end, in summary, what they said that an ESG corporate rating performance is positively related to valuation and profitability. ESG companies are generally good allocators of capital. ESG operators have high EVA margin stocks and they tend to outperform. And it's interesting that the first adopters of this have generally been in the technology, healthcare, and consumer non-durable sectors. But it's no reason why other manufacturing and small businesses cannot go out very simply on their website and say, these are our sustainability targets, these are social targets, these are governance targets, and we're very serious about them. And this is actually our listing against that. These are KPIs, and this is how we're performing against these KPIs. So if Armarenco wants to go to the stock market, let's say in 2024 in Paris, we've already been told that we have to have an ESG report for at least 2 years. If we want to have institutional funding, let's say from some of the largest insurance and pension funds, we have to provide them with a carbon footprint statement and we have to give them an ESG report. So the reality is that capital for growth in the future will come with some conditions. And one of those conditions is quite definitely going to be ESG credentials. KPMG did a study of Irish business in 2021, and the results are actually quite harrowing in the sense that we are way behind many other countries with respect to ESG reporting. Only 4% obtained any external assurance of their sustainability related indicators. 54% did not report targets set on any material topics on ESG, even including gender diversity. And you had 54% did not publish any sustainability related information, whether it be in an annual report or actually in a separate sustainability report, or albeit also on a website. So for a listed company, you can see 48% have a good basis for getting ready, 4% are close to ready, but 48% are far from ready. But the non-listed companies out there, 96% are far from ready, and 4% have a good basis for getting ready. So what I'm saying here is that there's a lot of work to be done in putting forward ESG tables and ESG KPIs such that your company is seen by your customers and by the public as a company that has the best of brand values, because these are extremely important aspects to the brand of any company at this juncture. So what is our approach? Up on the top right corner, Anna Dubois, who is married to a Frenchman living in Paris, but actually originates from Romania, is our head of ESG. And she is an extremely experienced person of 20 years in the sector and has worked for UN agencies as well. For us, if we increase the number of megawatts that we produce solar PV with, it means that we have environmental regeneration and we also create social value creation. So our dedicated ESG department basically ensures that we ensure clients have carbon neutrality, that they actually increase their economic competitiveness, and they create additional value for themselves and their local communities while achieving the regeneration of the ecosystem Earth. And this is a mission that we're extremely serious about, and it's a mission that our shareholders absolutely insist on. Clearly, one of them being a fund and the other one being a bank in France, they have particular requirements in terms of ESG that they have to meet, and they make sure that any entity that they invest in, that they propel exactly the same standards. So in terms of our targets, we're clearly doing things to keep global warming less than 1.5 degrees. We want to increase biodiversity and regenerate ecosystems. We want to transform economic and social systems and reconciliate economy with ecology. And we want to create local and social value through our activities. And these are all the UNDP sustainability requirements, which are listed actually underneath. For us, how do we do it? Well, clearly, we're going to reduce greenhouse gas by producing energy and clean energy and reducing soil release of CO2 by soil regeneration. We have an eco program for increased biodiversity, whereby we're putting in regeneration of ecosystems. And in Agri-PV, we build greenhouses and sustainable farming barns right across Europe now. And we're the leader in agricultural solar PV in Europe. But on many occasions, I have tried to get through to the Irish Department of Agriculture. I've had many meetings with them, and to this day, they still are not engaging properly with the opportunity for agricultural PV. In terms of reconciliation of the economy and ecology, we have regenerative capitalism and partnerships and innovation, and that's primarily around crowdfunding. In France, we do significant crowdfunding where we allow citizens of France invest in sustainable projects such as our own. And in creation of local and social value, we have community programs. We have community programs here in Ireland and elsewhere that basically give some of the turnover back to the local communities for various projects, whether it's going to be the elderly in a community, whether it's going to be a GA club or a soccer club or a rugby club. We actually provide monies in that regard. And clearly, we have to have the highest standards in health and safety. And most importantly, by the way, you have to have the right code of ethics. We import a lot from China, and there's been a lot of allegations quite clearly about slave labor in China. We do audits on all of our factories to ensure that people are being paid properly when they create the modules that are put up in all of our sites. So regeneration for us is a core commitment to restore natural ecosystems, soil health, biodiversity, and most importantly now, water management. So our pledge is to provide €2 million per 1,000 megawatts of new solar power plants and €500,000 per 1,000 megawatts of operating assets each year. So basically, that is a fund that we have set up for regeneration of soil in particular. You can see down at the bottom, you can see some of our Agri-PV on the right-hand side, which are greenhouses with panels and perspex openings, where we have a significant amount of horticulture. And we charge the farmer €1 for the use of those greenhouses every year. So that's actually adding value to horticulture, particularly in places like the south of France. Our impacts is that we increase carbon capture in the soil. We protect and promote biodiversity, increasing soil quality, increasing land productivity, increasing land cover through tree cover. We plant a lot of trees, and we fight desertification and artificialization. So we do this across all of our territories, and it's really important that we live our brand, and our brand is propelled on this particular basis. So we also have KPIs. And in these KPIs, you'll see that in January to October of last year, we'll have saved 2.147 million tons of carbon equivalent from the power that we produced. And that's equivalent to the total carbon emissions of Malta in 1 year. In terms of leader in Agri-PV, we've got 62 megawatts of Agri-PV installed in 2020. I've talked about the ECO program pledge in terms of the monies going into that. In crowdfunding, we collected 25 million in citizen funding in France through the postal service. Again, I attempted to try and do something like that in Ireland, and that just did not work. In terms of eco-design task force, we have blueprints for nature-based projects. We have a code of ethics that we abide by in terms of procurement for the Armarenco group and all of our suppliers and all of our subcontractors. And in terms of improving workers' health, last year we took 63,000 meters squared of asbestos off roofs and replaced it with solar PV. We also then have location-specific community development programs. And by the way, the delays that I suffer here locally as a result of various, how will I put it, legalistic planning interpretations is actually keeping 2% of our turnover away from the people in Inniscarra, in Timoleague, in Kilmoney and Carrigaline, primarily because in this country we have all of the requirements for community empowerment, but it's extremely difficult for renewable companies such as ourselves to actually even get our projects built because of the over-administration and bureaucracy and the legalistic aspects of planning in this country. And if it doesn't stop, we will not meet our targets and will be fined by the European Union. So we all have a role to play. This is an example of what we do. And I think, I hope that companies here in Cork can actually, maybe take a number of these particular objectives around how many females do we have at board level, at senior management level. We're well represented. 40% of our staff are female for what is in essence an engineering company per se. So we're very proud of that fact. And it's something that quite clearly going forward, you have to embrace ESG. And if you do not, you may actually find that customers will not be attracted to you because a part of your brand, whatever that brand is, needs to have ESG at its very, very core. So hopefully that has been, of use this morning. As I say, we all care. We care for Ukraine, but we also care for our environment. We care for our citizens, and we care for governance of our companies. And if we do all of that, then your brand will enhance and your profitability will improve, as per the ESG Matters document or the survey performed in 2020 by Harvard's Business School. Thank you very much.